Hello everyone, welcome back to our channel and welcome back to this video. This video is a continuation of the series that we have started about the book Poor Charlie's Almanack. We have already gone through the introduction. We've gone through chapter 1, chapter 2, which is basically the speeches 1 and speeches 2. And today we are going to discuss chapter 3. We have been reading from the Kindle version of the book, and this version that I found online is much more graphic and much more interesting. So, what we're going to do in this particular video is just review the talks 1 and talk 2, and then we'll start with talk 3 from this particular book itself. All right. So, here's the review, and I hope you enjoy the reviews of this graphical book. So this is chapter 4, talk 1 of Poor Charlie's Almanack. This is the speech that was given by Charles Munger as the Harvard School commencement speech in 1986. Again, you can see that this version is really graphic and it's going to be enjoyable to read from this particular version of the book. So here is the talk 1 revisited. So herein Charles Munger says that as I review in 2006, this talk made in 1986, I would not revise a single idea. If anything, I now believe even more strongly that, firstly, reliability is essential for progress in life, and secondly, while quantum mechanics is unlearnable for a vast majority, reliability is something that can be learned to a great advantage by almost anyone. Herein, he says that I usually go on to say that if the elite campuses were as successful as McDonald's in teaching sensibly, we would have a better world. What he says is that indeed I have often made myself unpopular on elite college campuses by pushing this reliability theme. What I say is that McDonald's is one of the most admirable institutions. Then, as a sign of shock comes to the surrounding faces, I explain that McDonald's, providing first jobs to millions of teenagers, many troubled over the years, has successfully taught most of them the one lesson they need most: to show up reliably for responsible work. Then I usually go on to say that if the elite campuses were as successful as McDonald's in teaching sensibly, we would have a better world. Now, this brings us to the end of talk 1. From here on, we'll start the next talk, which is the talk 2. As we said, we've already kind of gone through this talk in our previous video. What we'll do is just a little bit of review from this particular book before we move on to the talk 3 in detail. Now, talk 2 was a lesson on the elementary worldly wisdom as it relates to investment management and businesses. It was given in 1994. First and foremost, yes, this is something that I wanted to stress again, wherein it is said that you cannot use the natural swing that broad evolution gave you. You have to learn a certain grip and swing in a different way to realize your full potential as a golfer. If you always tell people why, they'll understand it better, they'll consider it more important, and they'll be more likely to comply. This is what I have also seen when you lead a team. If you tell the team exactly what needs to be done, what steps need to be taken, and then let them go on and manage it by themselves, then you definitely get a better result, a more cohesive team, rather than if you do not tell people what is expected of them. And if initially also they are kind of left to their own means. So this is something that I do agree with, and that is why I did want to stress that as we review the book. In this particular talk, he also talks about Walmart. He says that it's quite interesting to think about Walmart starting from a single store in Arkansas against Sears Roebuck with its name, reputation, and all the billions that it had. How does the guy from Bentonville, Arkansas, with no money, blow right by Sears Roebuck? And he does it in his own lifetime, in fact, during his own late lifetime, because he was already pretty old by the time he started out with one little store. And next, he goes on to explain as to why he feels that Walmart became such a successful story. Here, Charles Munger says that Sam Walton played the chain store game harder and better than anyone else. Walton invented practically nothing, but he copied everything anybody else did that was smart, and he did it with much more fanaticism and better employee manipulation. So that's the reason why he blew right by them all. He also had a very interesting competitive strategy in the early days. He was like a prize fighter who wanted a great record so that he could be in the finals and make one big TV hit. So what did he do? He went out and fought 42 palookas. Right. The result was a knockout, 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 42 times. Sam Walton, being as shrewd as he was, basically broke other small town merchants in the early days. With his efficient system, he might not have been able to tackle some titan head on at the time, but with his better system, he could sure as hell destroy the small town merchants. And he went around doing that time after time after time. Then, as he got bigger, he started destroying the big boys. Well, that was very, very shrewd strategy. And this brings us to a wrap up of the talk, too. Let's see what Charlie Munger says when he says that he revisited the talk in 2006 and he should have said that, or he emphasize on something else. So he says that as I reviewed Talk 2 in 2006, I thought it would be improved by adding, firstly, an attempt to explain the extreme investment success of Howard and Yale in the recent years. Secondly, a prediction about the outcomes for the many pools of capital that will now try to duplicate the past successes of Howard and Yale by copying or continuing their methods. Thirdly, a brief comment about the implications for the efficient market hypothesis as demonstrated in the 2005 book Fortune's Formula by William Poundstone. Charlie Munger says that to me it seems like that as Howard and Yale de-emphasized conventional unleveraged holding of diversified US common stocks, their investment success was boosted by factors including the five described below. First, by investing in LBO funds, Howard and Yale introduced leverage into their results by owning interest in US businesses. And the LBO fund structure gave them a way to make their leveraged business investments in a manner safer that is possible in normal margin account, prone due to panics to forced sales. Decent comparative results often followed in markets with tolerable general outcomes. And this happened even when net after cost results from the investments in the LBO funds were no better than that would have occurred through slightly leveraged investments in the index of US stocks. Secondly, he says that in category after category, Howard and Yale selected or directly employed investment managers who were way above average in ability, providing additional evidence that investment markets are not perfectly efficient and that some good investment results come from abnormal skill or other abnormal advantage. As one example, Howard and Yale, by reason of their own prestige, were able to get into some of the most profitable high tech venture capital funds not available to other investors. As one example, Howard and Yale, by reason of their own prestige, were able to get into some of the most profitable high tech venture capital funds not available to all other investors. These funds, using the momentum provided by their own past successes, had an opportunity advantage over well established venture capital operations in their best entrepreneurs, quite logically made early presentations to their best regarded funds. Thirdly, Howard and Yale wisely and opportunistically imitated investment banking firms by going into several activities that were non traditional, like investing in distressed US corporate bonds, high coupon foreign bonds, and leveraged fixed income arbitrage during a period when many good opportunities were available to skilled operators in activities chosen. Fourth, finally, the benefit that came to Harvard and Yale in recent years through leverage and unconventionality were often, of course, given a large tailwind by happy combination of declining interest rates and rising price earnings ratio for stocks. Lastly, Charles Munger says that the extreme investment success of Harvard and Yale gives me both pleasure and pain. My pleasure comes from the demonstration that academic skill is often useful in worldly affairs. People like me who were attracted to academia yet have gone into business naturally respond to such worldly achievement, much like many other modern scientists who relish the example of Thales of Miletus. This scientist of antiquity made a large profit by leasing most of the olive presses in his area just before the occurrence of a particularly bountiful harvest. He says that my pain comes from foreseeing a lot of future adversity for other worthy institutions driven by envy and salesmen into enthusiastic imitation of Harvard and Yale. Disapproval of the conduct of many of the salesmen likely to succeed in pushing the imitation, something similar to what I fear has happened near the end of high-tech bubble. At that time, envy of successful early stage high tech venture capital investors like Stanford, plus the dubious sales methods of many venture capitalists caused almost 90 billion to rush into low quality imitative early stage ventures that by now have created as much as 45 billion in net losses for late coming investors. Moreover, Howard and Yale may now need new displays of unconventional wisdom that are different from their last displays. It is quite counterintuitive to decrease that part of one's activity that has recently worked best. But this is often a good idea. And so, Also, with reducing one's perception of one's needs instead of increasing risks in an attempt to satisfy perceived needs. Talk 2 was made in 1994, about 12 years before this addendum was written, and during the 12 years, much useful thought and data collection has supported the idea that neither the securities markets nor the betting systems at racetracks prevent some ventures from gaining high, satisfactory, way above average results through unusual skill. William Poundstone's book Fortune's Formula collects much of the modern evidence on this point in a highly entertaining way. Moreover, the book also contains an account of the investment record of Claude Shannon, pioneer scientist in information theory, that makes Shannon methods look much like those of Charles Munger. So we'll wrap up the revision of the talk 1 and talk 2 here. Hope you've enjoyed this video. Do stay tuned in for the next one. Thank you.